I mean, the whole thing is sort of a joke. I mean, all it is at the end of the day is a giant Ponzi scheme in a way. If the Fed starts buying debt, the Fed Treasury issues debt, the Fed buys it, then the Fed pays the Treasury back.
Yeah,
I
it's a big money
back, right?
merry-go-round. It just goes around.
I mean, once the debt is created, the debt's created. It's not like it evaporates, but it's the whole thing. I think is just like, people.
Welcome to the Rose Show podcast. Welcome, everyone. I'm here with Michael Kramer. He is a frequent guest on the Rose Show, and I love working and talking with him about macro and markets. So welcome, Michael. How are you doing today?
Okay, how about you?
Good. I see you're still hanging out at the beach over there. It sounds like you have quite the charmed life. You're charting on the beach.
I could be on the beach every day of the year.
I love it. Awesome. Well, I always love meeting up with you. So let's get started with.
I just need a 5G. I just need a 5G Wi-Fi cell hotspot. I just need a 5G hotspot, and I'm good to go.
Sounds right. I'll join you too. Okay, so I'd like to get your take on an overview of what's been going on in the markets and macro. We could talk about the year end. November was a great solid month. What are your thoughts on all of that?
Well, I mean, overall, it's all been about, stock picking this year, right? I mean, we hear a lot about the S&P 500 being in a bull market, all that other stuff. I mean, clearly, if you look at the Russell 2000, it hasn't been a bull market, right? If you look at the RSP, it hasn't been a bull market. You look at even NASDAQ composite, it's been in a bull market, but it's underperformed the NDX, right? And so if you've picked the right stocks, you've had a very good year, probably. If you didn't pick the right stocks, it hasn't been a bull market for you. And I think that's what gets lost in a lot of the, back and forth on FinTwit or FinX, whatever it's called now. That people talk about the indices being, in some cases, up 20%. Which in theory isn't alone enough to really make something a bull market, right? I mean, the true definition of a bull market is when everything is rallying and doing well, and everything is in a broad-based uptrend. We clearly don't have everything in broad-based uptrends. So I think this has just been a very stock picker's market. If you own the right securities, you've done well. And if you happen to own, banks, or you happen to own biotech, you probably didn't have a very good year. And I think it's a very difficult market to navigate. It's not as easy as just, pick a stock, throw a dart at the wall and hope that it goes up. Just those days are over. I think we're in a period of time from here on, from 2022 on, to really where positioning matters, to where the stocks you own matter. Right. And how you go about doing that is everyone's own business. But I think the days of thinking that, the market's up, meaning everybody, you're up, are long gone. And I think that's the most important takeaway of 2023.
Well said. I love that. I agree as well. It's about picking the right ones and positioning properly. And as we saw, the Mag 7 had their big run. And everyone was talking about the bear market turning bull market, or saying it was a broadening. They saw IWM last week was starting to go up, and now we see it come back down. We don't know. I mean, it hasn't come back down to support yet. But yes, absolutely. It's
I mean, this isn't but going sideways isn't a bull market, right?
Mm-hmm.
I mean, this maybe was a bull market. I mean,
Yes.
All of this was a bull market. This isn't a bull market in itself. So I think like this is really where things are really lost. The RSP if you've been invested just like in the RSP or something similar, you've done nothing for some time, right? I mean, we're in the same spot we were in May of 21, which is the case for the S&P to some extent. But we can see that, the RSP from the October low, I mean, what is it? What is, if you go to the very, very low, it's up, what is it up now? 19%.
Mm-hmm. Something like that.
So it's just, I don't know. I mean, if you go from the very, very low, it's okay. It's up a little bit. I mean, you take this all away, just 4 weeks ago, it was up 6.7%. So, I mean, in the grand scheme of things, this is a market that's just churning. And if
Yes.
you want to define a bull market by a 20% rule, then, be my guest, but that's not really an indication of, in itself, an indication of a market that's really healthy and doing well.
Agreed. Well said. Makes sense. I think that it's definitely opportunities for traders. Depends on your time frame. So I know you're long term and you're long only. When you look
Right.
at it overall for like a long-term trajectory, we're not seeing real growth there. We're seeing a wide range-bound market sideways, like that. And
Right. I
there's
mean,
definitely, yeah,
I mean, the Russell
opportunities in that.
2000, the Russell 2000 just made a new low this October.
Yes.
So, I mean, okay, so it's up 16% from the low, but I mean, you can't look at this chart and say we're in a bull market. I mean, it's sort of comical in some ways.
Exactly. So that's why I wanted to bring up that concept, like you said, X-Twit or FinTwit, whatever they're called. A lot of talk about the
FinXers,
broadening, FinXers, talking about
I
the
don't know.
broadening of a bull market. And I think you
Yeah.
and I both have been pretty adamant about I was very hesitant to say the word bull market. There could be some cyclical bull markets in certain sectors where certain stocks, like you mentioned, but overall, collectively, in the markets, you're not seeing that with these indices at all. So,
And so, it makes it, I think, like I said, it makes this market, very difficult. And I think it makes it, challenging to try to really assess, especially when you're looking at it on something like on a year-to-date performance. This will take a minute to run, but I think it will be interesting to
absolutely,
see.
definitely. And I think we're seeing a rotation. What's going on? And you wrote a great article about growth to value, and I'm seeing that as well. And we'll get into that as well. So I've noticed that with the flows, it seems like the indices are sort of pinned in this range bound, and there's a lot of compression going on. But that's another story. But so tell us what you see here, Michael.
So the one thing I was looking at was just more recently the
Yeah.
SPYG to SPYV ratio. And
yes,
I look
the
at this
growth
just
to
to get a
value.
broader sense. Yeah, just to get a better sense of what's happening in the market. You can clearly see that since really October 17th, growth has been underperforming value, which is odd, right? Because we've been talking about the markets going higher, and it hasn't been the growth names leading the market higher, it's been the value. And what's interesting here is that when you look at the growth to value ratio and you overlay it with the NASDAQ, with the Qs, you can see that they basically mimic one another, except for like right here. So I don't really know what that necessarily means. Like, does it mean that growth is no longer leading the NASDAQ really higher? Or does it mean that there are some names that are growth, that are called growth, and they're in the value index? I don't know, because when you look at the two, first of all, a lot of them overlap, right?
Yes.
You're going to see a lot of growth names in the value, and you're going to see a lot of value names in the growth. But that doesn't actually, it doesn't. So it's not in itself a great way to figure things out, but it gives you a little bit of a sense of where the leadership is. And what it shows you right now is, for the most part, you're seeing leadership really coming more from the value side of things. So here's like the S&P 500, right? So you can run this on any really day of the week and get different values. So far this year, it shows that there's 312 stocks up. There's 211 stocks that are down, and one stock that's unchanged. So again, I think it shows you that this is very much like a stock picker's market. It's not overwhelmingly up to down. 3 to 2 is like a 1.5 to 1 ratio, right? And basically, I mean, if you had gone back and run this 3 weeks ago, it would have been lopsided the other way, where you would have had more down than up. So I think this has just been a very difficult year. And I think right now you're trying to see people maybe go into some of the names that haven't performed well, trying to maybe hope to find some extra performance there.
So when you look at these charts and you look at all this data here, we know it was a difficult stock picking year. What kind of feeling are you getting for 2024? I know it's hard, we're not going to be able to predict, but just looking at this pattern, what are you thinking for next year into 2024?
I think 2024 is going to have a lot more volatility in it. I think that this year was sort of the rebound from last year, and next year is going to be more volatile. I think whether or not that means stocks goes up or down, it's sort of hard to predict, because obviously, given where interest rates are, where the equity risk premium is, you would have thought that stocks would have gone down, but that clearly didn't happen this year. But I think the one thing that I know is that when the unemployment rate rises, which I think we're starting to see the very early signs of that, the yield curve begins to steepen, which we're also beginning to see very strong signs of happening, because this yield curve inversion is already one of the longest yield curve inversions that we've had in many years. And I don't know why this is on log. Anyway, the point being is that this has already been one of the longest inversions we've seen. I don't know where the chart is that I want it.
Yeah, we were noticing a bear steepening of the yield curve with the long end rising.
We were.
And now it's changing.
Now it's changing. But if you go back, this was the chart that I wanted. But if you go back and you look historically, I mean,
it's a long time.
The time that I mean, usually it's about 500, 550 days that you go from being, when you cross into negative to when you come out of net pop, come out. This was 336 and this was 560. And I mean, at this point, we still have a long way to go before we really get back just to zero. So we're kind of knocking on the door, I think, of time, right? I mean, the yield curve is not meant to be inverted, for infinity, right? It's meant to be that the 10-year yield's higher than a 2-year. But and so what that suggests to me is that the curve needs to re-steepen. What the shape that takes, I think, going forward is going to be more about the 2-year falling and the 10-year perhaps rising to the 2. But I think they're ultimately going to just cross paths, and the 2-year will probably go, and then I think the 10-year will eventually just kind of level off. And that's sort of key, right? Because once you start seeing unemployment rise, once you start seeing this yield curve steepen, that's going to be, your sign that credit spreads are going to start to widen. And once credit spreads start to widen, implied volatility goes up. And once implied volatility goes up, that's where you get your volatility in stocks. And so if implied volatility rises, that would suggest that stock prices go lower in 2024. If we get into a scenario where you're seeing unemployment rate rise and the soft landing narrative begin to fade.
So do you think next year could see new lows? Do you think, I saw you had a great article about 4,100 SPX. Do you think that we could be in for more volatility, but new lows as this recession, this much anticipated and talked about recession, actually comes to a head?
So in 2023, if you remember, when we spoke last year, we weren't talking, a lot of people were looking for a recession, but we were saying, no recession, right? That it was going to be sort of stagnation, like a stagnant sort of economy. And I would say we probably did a little bit better than stagnant considering the third quarter. But I think that it is starting to look like 2024 at least could shape up to have some sort of recession in it. And just because we're coming off of a third quarter that was very strong. GDP, the way it's calculated, is calculated on a quarter over quarter seasonally annualized adjustable rate, seasonally adjusted annualized rate. And, so that means that if we come off of a really strong third quarter and the fourth quarter just slows a little bit, that you could see a negative fourth quarter even, right? Just because it was such a strong quarter. I mean, that possibility is always present, right? And it's certainly present as we go into the first and second quarter of next year. But I think ultimately what I'm looking at is if earnings sort of, right now, the market is estimating that earnings are going to climb 10% next year. And clearly, if we're going to go into a recession or near a recession-like economy, you're not going to get 10% earnings growth. You're going to get no earnings growth, or you're going to get flat earnings, or you're going to get, maybe a negative number. Maybe it'll be flat, but you're certainly not going to get up 10%. And so, typically, I mean, an average PE is supposed to be around 16, right? And if you're doing $220 a share this year in earnings, let's just be conservative and say earnings even grow, 5% next year. And you multiply that by 16, you're talking about 3,700. So it doesn't suggest it doesn't suggest you make a new low, but you could get awfully close to the October lows. If you consider that little blip down, that was more like 3,490s, 3,500 area. But again, you could get close to that, right? And that's if there's 5% earnings growth, right? Assuming there's an average PE. If you were to get, 5% earnings growth or you were to get no growth and you were to get a 14 PE, right? Because there's multiple contraction, you'd be at 3,100, right? So it really, to say that we're going to go to new highs, I think are less likely. I think if I had to take a guess, I would say it's more likely to see a new low from here than to say there's going to be an all-time high. And that's based off of what looks to be like an economy that's going to have a rising unemployment rate and a Fed that's going to be very slow to cut, because remember, the Fed has been telling us they expect unemployment to go higher. So it's going to be about what rate gets them to actually move, because the market's kind of focused right now on this idea that the Fed's going to be cutting rates next year. I mean, it's very obvious they're going to have to cut rates at some point. It's a question of how much they're going to cut, because if they don't cut, as inflation comes down, if they leave rates where they are, as inflation comes down, the real rate will actually get higher and policy will grow more restrictive from where we are right now. And so if we have an inflation rate of 3.5% right now, and we're at a 5.5% Fed funds rate, call it, we have a 2% real rate, which is pretty much what the 10-year real rate trades at, which is 2%. If we go to 2% inflation and the Fed doesn't cut, and we have a 5.5% nominal rate, we have a 3.5% real rate, right? So the Fed has to cut at an amount that's 100 basis points to get us back to 4.5. We would still be at 2.5% real rate. So they have to cut in a way that's going to be in accordance with the decline in inflation, to keep the real rate from getting too high. Because if the real rate gets too high, then you're going to have a real problem.
Well said. Always appreciate your insights, Mike. You've been very consistent, and I love your thesis and the way you back it up with all your amazing charts. I have to add a few points to this. Now, I was just looking at the Fed Watch tool, and I know we always talk about that. And I said, let's look at the expectations. Expectations tend to always be wrong anyways. They always change them after they come out. They're always meant to be revised. So let's say, even with the best expectations, they're saying 400 to 425 basis points by December 2024. Okay, exactly in line with what you just said. So let's say we even go to that. What about the wall of maturities that's coming? All the refinancing that's going to be going on. Small businesses are already more sensitive to higher rates. And then the commercial real estate's already refinancing at much higher rates. And these rates now definitely affect the debt yields as well as the cap rates. Those have to go up much higher to take on that risk to cover this new higher rate for these mortgages. And then larger corporations, they're going to be refinancing to 2025. And, you know, in economics, it's always about the marginal, the change. So they're going from rates of loans on like what, like let's just say practically zero, very low, to now, even if they cut, everyone's all excited about a cut, even if they go to 400 basis points, that's still a significantly higher cost of money. And that will affect their bottom lines and their earnings going forward. Do you think that as well?
But take it another step. Who borrows at the risk-free rate of return?
They
right?
borrow higher.
Nobody. So that's just the floor.
Mm-hmm.
And if you're a high yield bond, I mean, you're 200 basis
That's
points
the
higher.
best case scenario.
But the
higher.
point is though, is if we actually see the economy slow, credit spreads will widen. It won't contract.
Mm-hmm.
So there's possible that we could see a Fed cut rates, but high yield rates may very well be where they are, or they could go up. We don't know, because we don't know what people will want to be paid for the risk they're taking to be in these.
Need to be compensated for
if
that.
you're going to the high yield junk bond market. I mean, if you're going, to the bank, I mean, again, we don't know what the credit spreads will be. I mean,
the
right
long
now
end can blow out. I think the long end can still blow out higher.
Of course, because right now, I mean, you look at the CDX high yield index, it's at 400.
Mm-hmm.
And, it was as high as almost 600 in the fall of last year. But more importantly, it was also near 300 when things were really good. So 250, 300. So, I mean, I can't imagine that we're going to go back to 250, 300 when the Fed had 0% interest rates and was pumping $120 billion a month into the economy. I would think that credit spreads stay where they are or they go higher. And so right now, again, equity risk premium, it's the same concept with stocks. Right now, people are willing to pay are willing to accept a very low,
very narrow,
a very small discount.
Where is it at now for the SPX and QQQ?
I stopped looking because it got like ridiculous.
So narrow. And that's the compensation that risk takers have over the risk-free rate. It's the yields in the SPX and the QQQ, and they've gotten so narrow. Remember we were talking last time, will it re-rate? Will it change? Is there a new
One time I saw
now?
it was at 1 point. Yeah, it's at 1.57.
Wow.
I mean, you can see where we are. It's also interesting that it stopped going down.
Mm-hmm. Yeah.
That this is where it stopped, right? And this is sort of what's going on with this?
See, I think inflation is not over, and I think we're stuck in the threes right now. We'll have to see.
You can see it just stopped in this 2003 to 2008. And it could be that this is the new range.
Yeah, exactly.
We don't know, right? This whole thing could have been just an adjustment to what the market is telling us is a higher interest rate regime, right? And the market is adjusting and removing itself from that easy money period of time that existed post 2008. That's what this looks like when you look at it like at first blush, right? That's what this looks like.
It's a different regime. That we're
so
in
we're
right
going
now.
back to the old way, the old equity risk premium, right? Where this was higher, this is just lower now, and that's very possible. I also have one for the S&P, if I can find it.
Man, the pink elephant in the room is the massive debt. The G in GDP should stand for government. The amount of government spending is significant. They just revised 5.5% from the 4.6. It's growing faster than they had estimated.
This is the S&P 500. What I did here, I took the S&P 500 earnings yield of the trailing 12 months. and I went back to 1970, right? Because that's as far as I could go. And then I subtracted it from the 10-year bond. And you can see where we stopped going down right here at 0.35, right? Which is just below the 2000 area and just above the 1980s and 1990s. It's almost like there's like a wall of resistance and support right at this zero bound. And that's where we stopped so far. And again, this could be telling us that this is sort of the lower bound, that you're not going to see the equity risk premium go negative. And maybe it doesn't go negative, right? But I think what this is sort of implying to me, at least again, is that we've left this regime behind. But what's interesting at the same time is that, the stock market is playing Fed rate cuts, thinking that we're going to maybe go back to zero rates. Wouldn't it be funny that after we got to the Fed rate cuts, if the market went back down, because the equity risk premium then went higher again to adjust for the old way of interest rates? Wouldn't that be like really ironic?
Very ironic, but I wouldn't be surprised if anything is possible at this point. But there's the go on, sorry. The S&P 500.
I was thinking about this.
Yeah.
I was thinking about this the other day, and I was saying to myself, like, it'd be really funny if after all this is done and the Fed starts cutting rates because the economy is actually doing poorly, because that's why they would have to cut rates aggressively, that the market then says, oh, we're going back to where we were pre-pandemic. This isn't the new world. And we are going to be back in this 0% world with no inflation, no growth, no this. And we have to put the equity risk premium back up again. We would be, 50% lower, 40, 50% lower in the NASDAQ. Because there's been that much expansion in the multiple.
It is. When you look at this, is a collective. The S&P 500 is 500 stocks. So you have the Magnificent Seven. Let's take those out. The other 493, they're not doing so well. Their earnings they're not highly liquid. They're not the ones that are generating cash. The big cash generators, these big companies with cash make a lot of money when they have higher interest rates because they're the lenders. They're the ones getting higher returns on their money. So when we look at right?
I mean, here are the numbers. I mean, I have them. You can see that earnings estimates for this year are still well below where they were in June of 22. And you can see for 2024, earnings estimates are well below where they were estimated to be for June of 2022. So earnings estimates have come down a lot. And you can see we've just basically flatlined. I don't know what's going on right here. This suddenly popped up. I don't know if there was a change in the components or whatnot. I emailed, but I haven't heard back yet. But in the meantime, if you look at the earnings for the Magnificent Seven, which Bloomberg actually gives you.
Oh, that's cool.
If I can.
Yeah, they're the ones holding up the market. And
that's where all the earnings growth is.
Exactly. So that equity risk premium is all the collectively in comparison to the overall SPX. So I think that's why it's like you said earlier, to your point.
So this is for the Magnificent Seven.
It's a stock pickers market. It's not the index, it's not the collective group, it's these seven.
Right. That's the point I was trying to make before, which is that you have to own the right stocks or you've been sort of left behind this year, or you have to be indexed. Otherwise, you've been left behind. And so if you've owned the regional banks, you haven't had a good year, right? I mean, it's just really that simple. I mean, if you've owned biotechs, you probably, like I said, haven't had a good year.
NVIDIA, yes.
Yeah, but that's, if you own the top 7 names like we spoke about, I mean, you're doing well. But otherwise, I think that this just highlights the fact that you either have to stick to being indexed, right? Or you have to be a very good stock selector.
Exactly.
I mean, in a way, you would have had to, and the funny thing is about NVIDIA is that other than
they're still extended multiples. I mean, the multiple's high.
Yeah, but I mean, look at where NVIDIA was in October of 22, right? It was $115. Nobody could have predicted that this would have happened.
No.
Nobody, because nobody saw if everyone had known that they were going to have this big earnings blowout and this big earnings growth and revenue growth, it would have been in the numbers and the stock would have, but nobody saw this coming. This, in my mind, was really more about, I don't know, I've been doing this long enough to say that maybe a lot of it was just luck.
No, there's always that luck factor.
You weren't sitting here in October of 2022 saying like, oh, I got to get into Nvidia now because they're going into AI. Nobody was talking about
now. There's
AI.
There's a great quote by Benjamin Graham that says, in the short term, the market is a voting machine. In the long term, the market is a weighing machine. So that voting part is that luck factor. It's sentiment. It's how people view them. They just chose this one. It's the AI stock. AI got hot. This is the stock, and that's it. And there you go. Everyone crowds into it.
I mean, I'll be honest here, right? When we got to this point in time, being, an investor that likes to look at things for the next 5 years or likes to invest in the next big themes, I hated Amazon for a number of years. I just thought it was overvalued. I viewed it as dead money. I wrote articles about it and all. But then when it got down into this area here, where was it? In October of 22 in here, around 100, I bought it because I looked at the numbers and I looked at the free cash flow from operations and I saw that it started to turn higher. And my analysis showed me that when free cash flow from operations for Amazon stock trades with free cash flow from operations.
That's
and they had reported a number that showed on a trailing 12-month basis, free cash flow from operations had turned higher. As soon as I saw that, I bought it. But at that moment in time, I remember sitting there saying to myself, do I want to buy Amazon or do I want to buy Nvidia? And I didn't buy Nvidia because at the time, I thought Amazon was a safer bet, right? I had the option to buy both. My analysis told me that Nvidia was probably getting cheap at that 115, 100 area. But my analysis also told me that Amazon was cheap as well. And I just picked Amazon because I viewed Amazon as the safer bet, meaning like I thought it would add less volatility to my portfolio. And Nvidia obviously had fallen much further. But if I had chosen Nvidia, my returns would have been, multiple of they are this year, obviously. But again, like that's where I think sometimes the luck factor comes in because you're given this option and these choices all the time to buy or to sell. And sometimes you make a decision based on what fits your needs the best. And at that point in time, Amazon seemed to make a lot more sense to me.
So what are you thinking now? Do you like that? And Nvidia, Amazon, what are you thinking about all of these? Are any of these calling you as a buy signal? Or do you think they're all extended right now? Are you just watching them? Or do you think they're more sell signals?
So for full disclosure, I own Apple, I own Microsoft, I own Alphabet, I own Amazon. I've owned all of them. Amazon I bought October of last year. Microsoft I bought sometime in January of 2019. Apple I think I bought in the summer of 18. And Alphabet I think I bought in around March of 17. Right. So I've owned all of these for a fairly long period of time. And so what I've learned with them is that I don't really obsess too much about where they are. I like to know when they're overvalued. I like to know when they're undervalued, but I don't really change my positioning in them because
the long term for you, right?
Well, it's long term, number one, and number two, because the reasons I invested in all of them, their stories haven't changed since the day I bought them, right? And because their stories remain intact, I think that there's still further for them to grow over the next several years. If that story were to change for some reason, and if for some reason, like I saw people leaving Apple's ecosystem, I would become very concerned, right? And I would probably look to sell it at that point. Or if my kids stopped watching YouTube every 5 seconds of the day, I might become a little concerned if YouTube, right? Because one of the reasons I bought Alphabet wasn't for Alphabet, for Google. I bought it for YouTube because I saw the growth opportunity there. Microsoft, all about, when I bought a data center. I mean, whatever you want to call AI is still part of the data center at the end of the day. And that's why I bought Microsoft. The one reason why I didn't buy Amazon till late was because I had, again, in 2019, when I bought Microsoft, I had a choice between owning Microsoft and Amazon. And because the way I do things, I don't like to jump into the market all at once. I like to dollar cost average in, but I don't dollar cost average in by picking one stock and putting, a little bit to work in that one stock over time. I just buy one stock and then I wait until another stock comes along that I think is attractive, and then I go in and buy that one. And that's just the way I go about doing it. But again, I had an option of buying Microsoft and Amazon, but I viewed Microsoft as a clean play on the cloud and data center, where Amazon came with all sorts of other baggage, like the low margin, no profit side of their business. Because all it was AWS, and that was really it, because the rest of their business never made money. So like those options and those choices, kind of steer you in a certain direction. At the end of the day, like, these stocks can continue to work, I think, for many years. Do I think they're overextended right now? Yeah. I mean, I sold actually a little bit of Apple back in, I think, August, just because it was becoming very large, and I thought the valuation was getting to be a little bit high. And I was also very fearful of this market, which I still am, because I think that there's significant risk here, given what I think is a very uncertain economic future. But that being said, if we started getting back to 4,000, if we started getting below 4,000, I think you have to start looking to buy things too, if you have ample cash, because I think your downside risk becomes less. It's like, I look at it like from the concept of, if I start getting down below 4,000 actually, it was funny because when we went to 4,100, which I was predicting for in October, I was like, oh shit, I got to go figure out what the heck I want to buy if we were to get down to that below 4,000, because I don't know what I'm going to do. I wasn't really prepared, because I knew if we got below 4,000, we were going to go into the 3,900s. And if we got into the 3,900s, I figured there was only like maybe another 10% downside to it. So that's where you want to start kind of picking away at things, picking up some positions that are fairly cheap. But
yeah, I like to find
I'm not going to do that up here.
Yeah, I like to find the growth stocks that are at a good value. And back in the day, I got SMCI, and there's quite a few of them. Those cash generators, free cash flow yields, high ones in that. And I love how you said free cash flows from operations, and that's key. You want them generating it from their operations.
From their business.
Yeah, exactly. I mean, that's the whole point of investing in a business. So I want to throw something at you. Now, we talk about a potential recession next year. And then, like I mentioned earlier, a lot of these companies are refinancing at higher rates. And that's going to affect their margins. So let's ask ourselves, who are the customers of these big companies? Now, we know these companies are fantastic. They're called magnificent for a reason. They have their cash flows, they're big cash companies, they're, invincible, right? But who are their customers? So let's say they sell to the smaller businesses, to all the people who are all affected, with the consumers affected, the consumers collecting debt at a much higher rate. So won't that impact their future earnings as well?
Of course it will. Absolutely.
So no one's immune. None of these are immune.
How could anyone be immune?
Exactly.
I mean, at the end of the day, Apple's a customer services business, right?
Yes.
They sell the product and then they have an ecosystem. Microsoft is customers is a consumer business too, but they have data center and they have other things too. But all these businesses, I mean, Google is very susceptible to people cutting back on ads. I mean, but the point is, it's with these, it's a little bit different. And I think what's different about these is that I don't go a day without using my iPhone and all the things that come along with it. I don't go a day without touching something that's made by Microsoft. I don't go a day without being in Alphabet's ecosystem somehow. These have not only created something to sell, they've created things to sell on an ongoing basis, right? And once you're in that ecosystem, I think it becomes very hard to break out. Ask an Apple user who's been on iCloud for 10 years to go start moving everything over to a Samsung and Android. Probably not going to happen. Could you
Yeah.
imagine transferring all those files of photos over?
That's why I'm not going Apple with all my stuff, because I don't feel like transferring over. So I'm staying with Microsoft.
But you get the point. Like,
Yeah.
I at it from like an ecosystem
I
standpoint,
know.
and not necessarily like
But will they upgrade to the new iPro 15? I think in
they may not.
contractionary times
But that,
and when there's
but
tightening liquidity, they may not. So that can affect
right.
them.
Oh, sure, absolutely. That could affect their revenue. It could affect their earnings, right? But the people who have one aren't going to probably get rid of it either.
No, no.
So they're still going to be paying service revenue, right? And that service revenue is really what's key, because if that service revenue eventually grows to a size that's bigger than the iPhone itself, then that's what really matters. And the service revenue is actually the higher gross margin part of the business, right? And so that's why I own Apple, right? Because that service revenue is really the key. And then these wearable things are the key too. I always thought services and wearables were the two sectors, or the two parts of Apple that could really drive the growth, because, you know, I have a watch, my daughter has a watch, we all have a watch, because a watch can monitor our where they are, right? For my kids, I know where they are basically at all the time, because they're wearing the watch. At least even if they don't have a phone, it monitors my health, right? I mean, could you imagine, like, you know, if you're older and you wear, you know, instead of giving your parents like a thing to wear, you remember the things they would press the life alert thing, you know, instead of doing that, they just wear a watch that detects if they fall, right? That automatically calls 911 for you. So I mean, from a standpoint, you know, there's a lot more room, I think, for wearable side of business for Apple to grow, because they can integrate more health features into it, not just on a watch, but maybe they do something in other.
Yeah, I mean, they're necessities. They've crossed over from just being like a luxury item, something additional, to being a necessity, like you said, like a life medic. I mean, that's keeping track of your kids. These are necessities, and I think they're inelastic goods at some point, and they're irreplaceable, and they're much needed. I was saying that about cybersecurity with the rise in remote work and businesses being virtual. Cybersecurity is an essential as well. So there's a lot of these newer industries, and people just need to think different about it. So my opinion, we get tougher times, we get contractionary, and we get tighter liquidity. I think these will most likely be the last ones standing. Like you said, the Apples of the world. Those are going to be the ones people are less likely going to give up on these services, as they're much needed. They're necessities.
Yeah, and it's not to say that they can't go down. I mean, of course they can go down.
Yeah.
Everything down. They can go down, you know, 40-50%. But the point being is that, you know, if Apple goes down 40-50%, the S&P is going to be like 50%. Right? You know, so the point is like, you know, if you want to be in the market, you have to be in the market. You have to try to outperform the market, because once you get out of the market, I know from personal experience, it's very hard to get back in. And so
you got to stay in touch with it. Absolutely.
You have to be, if you want to be in, you have to be invested, but you have to be able to manage your risk, manage your cash, you know, don't do stupid things like, you know, lever up too much, and you can survive some of these stormier periods of time. But again, like, I think it's just investing to me is always about longevity. You know, the longer I can play the game, the better off I'll be.
Absolutely. And it's about time in the market, not timing the market.
The time is the biggest component. I mean, the younger
you want to buy right. Absolutely. And that's why you wait. You know, that's another important point about you. And people say you're short, and you're not. You're just waiting. You don't want to buy an expensive company. You know, you don't want to buy something when that's multiple is extended.
unfortunately, I learned that lesson in 2001. I mean, I watched Cisco go from 80 to 10, basically. And I kept buying it along the way, thinking, oh, it's cheap now. Oh, it's going to be cheap now because, you look at the price at first and then you look at the PE ratio and the PE ratio comes down. You're like, oh, it's cheap. The PE ratio is only at 20. It used to be 80. Yeah, it's cheap until the company cuts earnings guidance and the earnings guidance goes down and the PE ratio goes back up to 60.
Yeah, you learn from those experiences.
So, I just learned that when you're in these periods of time that are like this, like, you just kind of take caution. There's no reason, that for me at least to be super aggressive at this point in time.
Not at all.
And so if I can be a little patient here, and like you said, I mean, I have things in mind that sectors of the market I want to be in, cybersecurity being one,
I love it.
robotics being another, artificial intelligence. But I'm more in this camp that I want to own not the maker of the chips, because the chips become commoditized over time. I mean, how many cycles do we need to go through to know that over time all these chips become commoditized and their margins shrink, right? That's just what happens.
They absolutely do. The equipment's like that. They definitely have tighter margins.
I own the companies that are creating the artificial intelligence. I want to own the software makers.
The software, that's where the higher margins are, the higher profit margins.
So I'm looking at things like that can grow revenues on a subscription-like basis, that have an ecosystem, that have a large moat, and that can deliver gross margins that are healthy.
So here's what I'm going to do. I'm going to let's throw out these index plays. Let's stop looking at ERP, the equity risk premium. Let's stop looking at SPYG, SPYV. Like you said, they overlap. Let's go under the hood. Let's forget these big top, broad-based, and let's look under the hood. And like you said, it's a stock picking market. It's individual names. They're the ones that have run. So while the equity risk premium is telling us one thing, we see when you look at the Mag 7, vastly different than the other 493 in the S&P 500. So it's about picking the right ones and aligning yourself properly, looking at the value in there, the cash generators, but also it involves some luck as well. Those are some great points there. I think that's a big takeaway going forward as well. How are you looking at the dollar, gold, yields? We talked a little bit about yields before, but now the dollar's starting to go back up. It looks like it's getting some strength. And now we see gold hit that new high. It was like, would it go 2,100 and change? Now it's come back down a little bit. Are you bullish on gold or any of the commodities? Or what are your thoughts over there?
So I did a video for my subscribers about a month and a half ago, and I was saying that if we're in a period of time where we're going to be in this higher inflation world, and the equity market is completely wrong, right? Which makes sense. 5 million people have left the labor force. Labor force has only grown by 2 million. There's just too many needs for jobs. I mean, JOLTS shows you it's still almost 9 million job openings. So if wages stay elevated, you're going to see inflation stay elevated. Maybe it's not 8%, but it could be 3 to 3.5%, which is
that's what I think.
50%, 50 to 70% higher than what the inflation target is for the Fed, which is significant. Then we need to I need to find something that I can put in my portfolio as a hedge, because what it tells me is that the traditional idea of being long stocks and owning bonds as a hedge no longer will work. It's quite possible you could be in a period of time where the market can go down in stocks and bond prices can go down, which is what we've experienced the last 2 years or so.
Yes.
And that's very possible it persists. So now you got to find an alternative. Where would be a place for you to go to hedge? Well, I mean, cash is always an option because you have your cash stays flat, right? And you get a money market rate as long as the money market doesn't
Mhm.
break a buck, which happened in 2008. But that's one option. Cash is always an option, right?
Mhm.
And I don't really think about, losing cash. People will say, well, but yeah, you lose value on cash because of inflation.
Mhm.
But it depends on what you benchmark it against, because if you own cash and the S&P 500 and stocks are going down, your money is actually appreciating versus stocks,
Yeah.
because you can buy more of them at
Plus you have
lower price.
liquidity, and liquidity is an
Right.
important factor as well.
So I view cash as a very strong alternative. But the other alternative that I was thinking about sort of begrudgingly, because I've been not a fan of gold for a very long time, is something like a metal, a gold, a copper, a silver. My immediate knee-jerk reaction was to be like platinum. And people will be like, why platinum? Why palladium? Well, because there's an industrial use for platinum and palladium, plus the Russians control much of the palladium market. But that would, I mean, think looking for things that have uh not only a monetary value, but also an industrial use value. The only thing with platinum and palladium, obviously, is that we're going away from ICE engines and the catalytic converter to more electric, right? So maybe the use case for platinum and palladium depreciates over time. But I mean, it seems like looking for that alternative asset is there, and owning a hard asset like a gold, like even oil, could be a way to do that. Right now, I haven't really come up with the answer yet. I don't really know what the best way to go about it is. It's something I'm still thinking about and trying to figure out. Eventually, it will come to me, but it's just something that I don't have a real feel for. Maybe it is gold, right? Maybe gold is the answer. Maybe it's silver, right? I don't know, but I think that there will be a need to own some sort of alternative, and that bonds aren't going to be the safe haven going forward.
Yeah.
And so you're going to need to look for some sort of commodity to do.
This is something I've been talking about for a long time. It's great that you're thinking about it. There's no reason to rush into anything. It's just to analyze, start thinking about it. And definitely the 60/40 has performed as one asset class instead of being diversified. There's no diversification there. So we're looking for alternative asset classes. And I know you're not really into Bitcoin, but I would say check out Bitcoin, learn it, study it, and try to understand it. Bitcoin performs as its own asset class, different than the other ones. And then gold and silver, great points there. Inflation hedge and monetary debasement hedge. Now, we didn't get into the debt, massive debt, 34 trillion, interest expense over $1 trillion a year. They're spending to no end. And like I said before, the G and GDPs for government. And I think if you take out the bloating of the government spending from the GDP, you would see that the private sector is in a recession. And then when we look at the unemployment numbers, which we talked about briefly, all 50 states went up and we see 3.9%. Okay, 3.9 doesn't seem that high, but it's been increasing significantly. That is a lagging indicator. My opinion is we could very well be in a recession. And you don't usually know when you're in it. Sort of like when you're a little after.
Like
So I
halfway
think,
through it.
right? I think it's like pockets. I think just like the market. Let's do an analogy. The market reflects the economy in that there are pockets. There are pockets that the stocks are doing really well, like the Mag 7. And then you have the others part that's not doing so well. So in the economy, I think we're seeing similar. Then, Peter Bookvar was great. He was on here and he said that real estate, he called it a stagflation. It's not worse than a recession. It's like in a stagflation. And
Yeah.
because it affects so many elements, because you're in a standstill in the housing market. Home prices are still up, low inventory. So I think that the economy has pockets as well
Yeah.
tightened. So I think, my opinion, I hate to be the doomer here, but I think there's very well a chance that it could get much worse before it gets better. And what do you think of that?
Yeah, I can't disagree. I mean, I think there's a lot of questions. And I think that there's a good chance. I mean, we haven't had rates like these in decades, right? In 2 decades,
Yeah.
3. And I think it's a new way of living. And I mean, inflation is not. I think people think inflation means that price, lower inflation or inflation coming down means
Yeah.
that prices are going to go
Disinflation.
down.
Mm-hmm.
Prices aren't coming down,
Mm-mm.
right? They're just rising less.
Exactly.
They're
They're
rising.
decelerating. Mm-hmm.
They're rising slower, right? They're not rising as fast. But they're
But they're
still
still
inflating
rising, right?
and they're still rising. And the scary thing is the Baltic Dry Index, which
Oh, can you pull
has
that
just
up? Great.
has gone like parabolic.
Mm-hmm.
And I worry about what this message is.
Let's look at that. Wow.
I mean,
Yeah.
look at
I
this
love that
move,
you
right?
watch all these. This is important. Mm-hmm.
I mean, this is from what I understand, there's like a drought in Panama, right? So the Panama Canal water is fairly low, but I mean, everything passes through there, right? So if the cost to ship is going up parabolic, I mean, this is like a straight line. I mean,
Wow. I mean,
this was November 21st, right? And I mean, the move is staggering. If you go back from here to here,
yeah, I like when
that's
you do that.
140%.
That's,
It's doubled.
let me
You know, it
guess,
went
you
from
were fully
14
invested in that one, right?
No, I wish I
Me
could, but
either.
you can't. Went from 1380 to 3300. I mean,
Wow.
how can this
Yeah.
not be inflationary?
There's a lot of, and look, you know what else is inflationary? The way the government's spending. So inflation's not over. We're stuck in the threes. And that's exactly why I don't think they're going to be cut. I don't see cuts right now. And, Powell has said he's going to remain hawkish. He's going to remain that way until the job's done. They don't want to prematurely cut. If they do prematurely cut, well, I think we're going to see probably a bull steepening mixed with a bear steepening. I think that the long end will still blow out as the short term come down with the rate cuts. There are a lot of potential headwinds there. But yeah, this is an excellent point of inflation still being embedded, entrenched. And this is a clear example.
The truth of the matter is you won't feel this for a couple of months.
Yeah.
Because this is going to show up in goods inflation again.
Yes, in the next 3 to 6 months.
So, I mean, and the thing is that
then
goods
the data,
inflation,
another 6 to 12 months.
right, and goods inflation has come down a lot, right? And really, it's the services inflation that's been sort of stagnant and not coming down.
Mm-hmm.
So, if goods inflation starts coming back up to services, and that becomes a significant risk. So, I just continue to think that, like, I think there's a lot of things that still need to play out, and I don't know. I'm not going to be the guy that tries to pick the exact moment the market tops and think that I'm going to, get out of the market immediately, right? And maybe as a retail investor you can do that, but I'm working on an institutional, buy side desk. Like, I know that it takes, months and sometimes, weeks and months sometimes to reposition a complete portfolio, especially a very large size. So, and if some of the names you own are very illiquid, it could take, 6 months for that to happen. Right. And so, people are already, people in those situations don't have the luxury of picking the top, right? So they always have to be sort of planning ahead and allocating appropriately and managing their risks for what they see as coming. And so, it's really hard, I think, for someone sitting at home, trading their own account to just press a button and then they're out. Because what happens is that then the market comes down a little bit and they've been trained to buy the dip. They buy the dip, but then the dip turns into a trough, and then and then they sell, and then they come back in, and I don't have the stomach for that anymore,
Yeah,
right? And so my feeling is that this is a question, this is a timing question, and instead of trying to pick every market turn and trying to reposition my portfolio on the fly, I'd rather just be positioned for the worst right now. And that means that if it means carrying extra cash, then that means carrying extra cash. And that's it. And that's sort of the way that I've dealt with it.
Yeah, I mean, number one is risk management, and that's number one. And there's 4 elements involved with investing: the risk, the returns, the liquidity, and the time to maturity. And those are the 4 key elements. So number one is risk management. And if you don't feel feel good about this market, and I mean, there's a lot of factors that, cash, you're getting paid 5.5 in T-bills. Okay. Can't complain, right? That's the highest we've had in what, like, since pre-GFC.
Yeah,
And
people have
so
been complaining for years about how they get nothing on their savings. Well, now you're getting something on your savings.
exactly. And people have recency bias. They're conditioned to buy the dip, like you said. And another asset that, going back to your thing about asset classes, looking for inflation hedge and monetary debasement, gold, silver, the commodities, the real assets, cash generators, those are all important. And then, like you said, cash, liquidity, T-bills are great. And I've been doing ladders of them. I do the 4-week and then I just stagger them that way. And they just keep coming out, and you have that liquidity flow. So 3 months or less T-bills. And then, that's another interesting asset class. I had some amazing person here last week, Michael Cow, who talked about CLO equity. And they have ETFs for that. And some of those yield double digits. And so that's another interesting asset class to look at, is the CLO equity. And then there's a structured products. Just want to throw this out there as well, that a lot of funds are doing the yield stacking. They're taking the T-bills, and then they're also using derivatives on top of that, because they're using that as collateral, and they're able to do that. So there's so many different people are able to really benefit, lower their risk, and benefit with these higher risk rates. So there's no reason to take on extra risk, like you said.
Yeah, I mean, you just have to do what lets you sleep at night and how you feel comfortable and how you're.
Yeah, I think I like to sleep at night. What about you?
I like to sleep at night. I like to take naps during the day too. So
Oh, I love it. I want to talk about the reverse repo facility. You are such a great teacher, Michael, and I think that you can show us that chart. You actually tweeted about this, and there's a drain going on. It increased significantly in 21, 22, and then now it's coming down. I think the biggest threat is really these treasuries and the debt. But let's take a look at that and what's going on. Now, the reverse repo is when the banks give cash to the Fed and they get securities, and that's that overnight. So show us what's going on
basically the Fed created too much liquidity. So they had to figure out how to make sure the liquidity doesn't push rates like negative.
Money merry-go-round.
Right. So they had to figure out how to make sure that rates didn't go negative back when they were at zero. And so they created the reverse repo facility, which has always been around. It just wasn't in use. Reverse repo facility is where you go and you have too much cash, you go to the Fed, they give you collateral and they pay you an overnight rate. And then but what's been happening now is that because interest rates have risen, the Treasury has issued an infinite amount of treasuries, that there's other options now that are paying higher rates than the 5.3% that the reverse repo facility pays. So because there's other options, we've been seeing the reverse repo facility drain. And it's around 800 billion now, but at the peak, I think back before the debt ceiling, it was maybe around 2.2 to 2.5 trillion. So you've seen a lot of money leave the reverse repo facility and it's finding a new home. But what's happening is you're starting to see a little bit of signs of some of that liquidity not being there, starting to affect rates overnight. And so like the other day, the SOFR rate, which is a secured overnight financing rate, popped up to 539, which was a very big move. I mean, if you go back and you look at this chart, you can see the blue line doesn't ever really move up by that amount.
What does that mean?
So you have two counterparties, right? Right now you have the Fed, you have an institution. Institution goes to the Fed, gives the Fed cash. The Fed gives the institution collateral.
Yes.
And pays the institution interest. Now you go the other way, right? The institution is in need of cash.
That's
Okay.
the
So it
repo.
has to find a bank to go and give it cash. So in this case, the bank gives the institution cash, and the institution gives the bank cash and a rate of interest, right, for that. And what's happening is that as liquidity is potentially leaving the market and these market rates are moving up, you're seeing these institutions that need cash have to pay a higher rate in order to get the cash they need in order to do to run their operations, so so to speak. But what happens is if you get to 5.5%, that's where the Fed's repo facility kicks into place. Not the reverse repo, but the repo facility. It's a facility where the Fed will take collateral and give cash, and the institution will have to pay the Fed.
Yes.
And that sets the ceiling, right? But
Exactly.
the thing is that why this is important is because right now, as the reverse repo facility is draining and liquidity is leaving the market, it's adding reserve balances into the system. But what would happen is if institutions started to go to the Fed and the Fed had to start giving out cash, it would lower reserve balances and take away from the excess reserves that are in the system. And this is more of like a mechanical under the hood type of thing. This was like similar to what happened in 2019. Basically, what this will tell us is if we start seeing the usage of the repo facility going up, it's going to be a sign that the Fed has drained too much liquidity out of the system, and they're going to have to stop QT.
Yeah. Well, most people, thank you for that explanation. Most people do believe that eventually the Fed will have to go back to printing money and go back to QE because of all this massive debt they've been accumulating. I remember I was calculating just in November alone, it was like 200 billion or something. And, they're estimating another trillion, just the first half of next year, I think 1.6 trillion.
You mean for the Treasury?
Yeah, the Treasury, exactly. So the government's accumulating that debt. How are they eventually going to pay off that debt is the question. Tax receipts.
They don't have to.
They're going to print.
Yeah. I mean, we're the reserve currency of the world. So
that's what Alan Greenspan said.
Like,
we'll never default. The U.S. will never default.
I don't understand why people obsess about the debt of the U.S., right? Go back and watch like an interview from 1980 when Ronald Reagan's talking about the U.S. debt reaching like $1 trillion for the first time. I mean, it was like a big deal. Now we're 30 times that, right? It doesn't matter. I mean, as long as the U.S. dollar is the reserve currency of the world, and we have the ability to print our own dollars, it doesn't matter.
And the U.S. dollar is the global reserve currency, and there's no contender.
Who's going to replace the U.S. dollar as a world currency? China?
No, the BRICS is not. The BRICS is
such
misinformation. No.
Who like overnight sets their own currency rate and tells the market where it can be?
I mean, oil is in U.S. dollars. BRICS has two that are capital controlled, two currencies capital controlled for a week. There's no, and then you have the euro.
I mean, it's going to be the euro.
No, the yuan. No, none of them are stable or liquid.
The euro was the euro was going to be a thing off and on. Back remember 2010, 11, 12 with Brexit. Before there was.
How do you feel about the U.S. printing more money?
That's what they do. I mean, I don't know what to say. It's not going to change. It's not going to change until the government has the stomach not to do it. I mean, there was you remember when in the 90s we thought we weren't going to have any debt anymore because we had a surplus, right? I mean, but that led to a really great economy. I don't think right now we have the political willpower to stop printing money. We don't have the right leaders in place. I don't think we have the politicians who are willing to stomach the need that comes with that. it's just, unfortunately, it's just the reality of things, right? And until people stop buying our debt, there's really nothing to do other than print more and then continue to inflate our way out of it, which is what we've been doing.
Yeah, but as they print more dollars, then we're going to have more monetary debasement and higher inflation. That's just the
But
reality.
you've had that for what, the last 80 years?
Yeah, but
I mean, it's all relative.
Right? I know. COVID
all
really
relative.
accelerated.
I mean,
they doubled their debt.
Who knows how much debt China has?
Or we don't know. We don't know any of that. Whatever they say is one thing.
You know, look at all these European countries with their 140% of debt to GDP ratios.
Yeah, well, Japan has a significant.
Well, look at Japan. What is it, over 200?
Yeah.
I mean, they own like half. They own like almost the entire, JGB market, right? It's just like, people worry about the debt. I don't think there's really anything to worry about there. Again, until we lose status. I mean, I don't know that we're going to lose status in my lifetime. I hope we don't lose it in my children's lifetime. But until there's a real alternative to the US dollar, which there isn't.
There isn't an alternative. That's the key, is the contenders.
Then
there's no contender.
Matter.
No matter how bad the dollar is, they're all worse. So it's like so there's no real contender.
That's what I mean. Like everyone, when the dollar was strengthening last year, a lot of people were like, I don't understand. I thought inflation was supposed to make the dollar worth less. I said, it does relative to the goods or services you may be buying. But why is the dollar index going up? Because everyone else has inflation and our interest rates are higher than everyone else. And they're expected to go higher than the euro, right? They're expected to be higher than the yen. So our dollar is appreciating relative to those currencies, because while we have inflation, their inflation is just as bad. And their rates are much lower, right? And in Japan, they're just not doing anything. So it's all a relative game. That's why it was like, you can't have cash, because if you have cash, you're losing money sitting in the money market account. Well, I may be losing it versus some other good or product, but I'm making it versus stocks, because stocks were going down. I was getting more purchasing power. So this whole inflation game is just a game of relative. What are you comparing it against? So I don't even waste my time thinking about the debt, the dollar. It's not going anywhere, in my opinion.
That's interesting opinion. I like that. That's a great perspective. Who cares? Forget the debt.
It may result in higher rates, right? But I don't think it's like the US government is on the brink of collapse and we're going to have like a crisis in treasuries.
There's always opportunities there's many different investing strategies. That's one. And there's different ways. There's people who hate gold and there's people who love gold, and they both make money. And everyone has their own way. So I always say everyone needs to just do what works for them. And there's so many different perspectives, but I love that. And you know what, Mike, you always have a sound thesis, and I respect that. And even though we differ with some views, there's always opportunities. And during these challenging times, I think let's just finish on this. Let's talk about some opportunities that you're seeing potential and into next year. And I know we touched a little bit about outlook for next year, but what are you eyeing? I know you're starting to think about potential inflation hedges. And what else? What are your thoughts overall from everything we discussed, and what you're looking forward to for opportunities?
Well, originally 2023 was supposed to be the year that I finally got my opportunity to turn bullish. So that didn't happen. So I'm hoping in 2024, I'll get that opportunity. And I think that along the way, I hope that means getting opportunities to own things in robotics, own things in healthcare, things that are specifically improving the human body, right? In ways of like, joint replacements, knee replacements, because those are all things that as we get older, we need. the technology that goes into not only making those things, but also detecting them. Because I mean, I think a lot of our health technology is pretty outdated in terms of the way it's used. And obviously, like cybersecurity is a big space that I want to be into. Like we talked about earlier, I would love to get the opportunity to look at some of these AI names that are actually doing something interesting with the software. But a lot of the things that I invest in are things that I come across not because I'm like scanning the web and looking at some sort of spreadsheet that's telling me what things are trading at relative to some obscure thing. It's just from going out there and looking at things and going to the mall and picking things up and touching them and figuring out what's cool, what's not cool, what really catches my eye. Like watching to see what my kids are interacting with. Like all of a sudden, all they do is use Snapchat, and I'm like, Snapchat, like that's like so, but that's what the new thing is, right? So it's things like that. And it's looking at these, I love just walking around the mall and just seeing what people are buying. I was a buyer of Shopify, not because, I mean, from a valuation standpoint, it made sense. But Shopify was a stock I wanted to buy for over a year, but I wasn't going to pay those prices for it. And I wanted to buy it because I used it. I integrated it on my website for a little bit of time. Like, this is the most incredible thing I've ever seen to be able to integrate and create an e-commerce store. And then to be like, I'm going to have fun. I'm going to sell t-shirts. And they create the t-shirts, they drop ship them, like you never had to touch a thing. So those are the types of things like I'm really sort of into, or things that I'm using on a regular basis that I can relate to.
Yeah, you know why? Those are leading indicators. What you're using right now, what's hot and popular now, will show up in earnings in the future. So that's excellent.
It's like Tesla. Yeah, I mean, that's how I bought Tesla in 2014. It was the same concept, right? I would see them, in Roslyn, or I'd see them in Manhasset, or I'd see them on the North Shore.
Yeah.
And I would go up and I would ask people, how do you like the car? They would say they love it. It's the best car they'd ever driven. I mean, if you're driving around a $130,000 car, you're probably coming out of something equivalent, which is like a Mercedes S or a BMW 7. And if they're telling you it's the best car they've ever driven, and Mercedes and BMWs are among the best cars that, on the road, then that's telling you a lot about what that quality of that car is. Right. And then I bought the stock and I would just watch to see how many new cars were coming, were coming out on the street. And that was the type of thing that I did for that. That's the only reason I stuck with it all those years.
Love that.
So, I mean, I look for those type of opportunities all the time. They don't easily come up, and it's like the type of thing that once you see it, it. And that's the way I go about doing a lot of it. And so I may not have an idea for 6 months or 9 months. And then like I was driving on the road the other day and I saw a car. I'm like, oh my God, what is that thing?
Is that a Rivian?
No, I was driving on the expressway and I saw it. And when I was a kid, my parents owned Lincolns, right? Like the Lincoln Mark 7, Lincoln Town Car. Those were big cars in the 80s and 90s. And I saw this thing and I'm like, oh my God, that looks like a Lincoln, like a future version of a Lincoln Mark 7, like Mark 8. Like I looked at the thing and I'm like, that thing looks really, and then I saw from the front, I'm like, that thing is amazing looking. I've never seen a car that really, it was like kind of like when I saw the Model S for the first time.
What was it?
I looked at it, it was a Lucid.
Oh, those are nice.
And I just saw another one today.
Those are very nice.
And I looked at it, I said, Lucid. I'm like, but that's a junky stock. I'm like, what, so I'm like, I have to I'll take a look at it and I'll see.
Yeah, maybe it's a leading indicator for a future winner. That's a good one. I love it. I love that realism. And I agree with you. I think that's an awesome way of finding great companies. And then, okay, so just briefly, cybersecurity. I'll give you my pick. I like my Zscaler, #1, my favorite. I love that one. I've had it for a long, I mean, since that was an April 2021 for me. Fortinet, I do like. I know it hasn't been so great lately. I still think it's a great team over there. Palo Alto, excellent. Great one over there. And CrowdStrike. Those are my my top ones in that one. And then AI, go for it. What are some AI that you're watching? anything.
Well, I already own Microsoft, and I think it's hard to really get
Love
anything
Microsoft. Bing is
better.
amazing.
Yeah, I mean, I think it's hard to get anything that's better than Microsoft at this point when it comes to that. But again, like I'm in the process where I want to start looking to see if there are opportunities. As of right now, I don't have anything else, but I'm with you. Like I want to own Palo Alto, but
Love it.
probably below 150, right? And I may not get that opportunity. I don't know.
But it's about
But
buying right.
yeah, I certainly don't want to own it up here,
No.
or be buying it up here. But yeah, Microsoft is certainly one. I think AMD is another name that certainly interests me in AI, because I think if NVIDIA's results showed us anything, it's that what's good for NVIDIA will be good for AMD. And I think that AMD may present, you might get an opportunity to get into AMD at lower prices, probably at a better valuation than what you could do for NVIDIA. The only issue I have with AMD is that I'm afraid of that commoditization over time on these chips, just like everything else. So that's sort of like the one hang up I have there. But I'm also looking at things like Zoetis. No one knows what Zoetis is, but if you have a pet, you probably know Simparica, which is their flea and tick medicine and heartworm medicine that Zoetis makes. And the price of it just keeps going higher. And the one thing I know about owning a dog is that as they get older, they become more expensive, right? Because they get sicker. And you're going to do for your dog like you do for your kids. And everyone during COVID got puppies, right?
Yeah.
And so that's something that I think can have a nice run for a good 7 to 10 years.
Awesome. This is
Again,
exciting.
Want to buy it at lower levels though.
Awesome. Well, I'm excited. Got cash in hand, ready to go. We'll have to
Ready to
watch for these
go.
prices, huh?
I'm ready. So
Well, we're excited. You're getting me excited looking at watching for these great names come down, hopefully, in our buy range, because it's always about buying right. And you make your money when you buy. So, it doesn't, and I'm going to just end on this. It's not about just owning something. Like you can always go and buy that Palo Alto, like you said, but it's about buying it at the right price. So being patient. Patience is a virtue, definitely in the markets and in life. So awesome. Thank you so much, Michael. This has been so much fun. We talked about so much. And we said before we started, we'll make it 45 minutes or so, but somehow it never goes that way.
An hour and 5 minutes later, we're under.
Exactly. And we'll definitely meet up again. So thank you so much, fellow listeners. Thank you, Mike. And check out Michael with his amazing Substack. Twitter is where you find everything. He's on Seeking Alpha, Mott Capital Management. Right?
That's right. Sounds good.
Thank you so much. Take care.
Okay, bye. Bye.